Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, now in our 27th year in business. It's Monday morning, December 28, 2015, and the title of this week's audio blog is 2014 and 2015 Review and 2016 Predictions. Actually, it's still Sunday morning, but this might take some time to complete before taping tomorrow. I always find the process of wrapping up and predicting fascinating, going all the way back to my Wall Street sell-side days of 1998 to 2005. Generally speaking, this annual write is as biased by self-interest and marketing angles as any in the business, and thus must be taken with the proverbial grain of salt. Moreover, in an increasingly complex political, economic, and financial world, engendering hundreds of relevant, rapidly changing known unknowns, and unknown unknowns, i.e. black swans, it's nearly impossible to make such short-term predictions, particularly when government intervention has become more pervasive and targeted than at any time in history. In other words, no one has a crystal ball of what will occur, although with a good knowledge of history and a firm hold of fundamentals, it's a good bet most big-picture predictions will eventually come true. On Wall Street, few people refer to their prior forecasts when making future prognostications, given how painful it is to review where one's been wrong, even if in many cases the reasons for being wrong were entirely out of one's control, such as, for instance, shock and awe, manipulation campaigns, or the aforementioned black swan events that crop up out of nowhere. Such as a terrorist attack in Paris, for instance, although in the big picture, history tells us such events nearly always arise from difficult times, whether they're incidental, false flag, or otherwise, which in the case of Paris, we may never know. Given that economic Mother Nature's ultimate, indefatigable presence often takes longer to emerge in today's highly volatile, heavily manipulated market environment, I'm going to have to do something a bit different this year with my wrap-up Outlook audio blog, which is to briefly review my 2014 predictions first, made in December 2013, followed by the 2015 predictions I made a year ago, and finally my 2016 forecast, which as usual I promise to do as objectively and honestly as possible. Remember, Miles Franklin is decidedly not a financial advisor and not focused on short-term predictions of what the price of gold and silver will be, say, 6 or 12 months from now. To the contrary, our goal, both personally and professionally, is long-term wealth protection and disaster preparation. Thus, if the combination of my 2014 and 2015 predictions is anywhere near the current truth, I'll feel comfortable that I have, for the most part, gotten it, with a better than average chance of being dead on regarding the monetary endgame, which in my mind is unfolding as we speak. And before I start, please keep in mind how difficult it is to predict the unpredictable, particularly with such a short-term time frame. Okay, here goes with my 2014 predictions made 2 years ago this week, which, by the way, I haven't even looked at before making this review. Number 1. Worldwide interest rates will continue to rise, but central banks will do whatever it takes to suppress them. Well, 1 out of 2 ain't bad, but it's number 2 that counts, as ultimately central banks have suppressed rates, thus creating historically negative real rates beyond my wildest dreams, or more aptly put, my worst nightmares. Last month's ECB expansion of negative interest rates only puts an exclamation point on the trend of global ZERP to infinity that inevitably may well put nominal interest rates for the vast majority of first world sovereign bonds in negative territory before the inevitable hyperinflation, as we are currently seeing in third world nations like Venezuela as we speak, arrives. Number 2. Obamacare's initial economic impact will be devastating. Well, I couldn't have hit that one more firmly on the head, as healthcare has not only since become the largest component of GDP growth, but has been such a massive drain on corporate profitability, it has single-handedly led America's disastrous transformation to a gig economy of part-time, non-benefits paying workers, which will only worsen dramatically in 2016 as the employer healthcare mandate that was delayed 2 years ago takes effect. Heck, not only have the government's own Obamacare exchanges been failing left and right, but the nation's largest private healthcare insurer, United Healthcare, is threatening to leave the system entirely due to Obamacare catalyzed financial losses. 2 months ago, I wrote that Obamacare would be the bullet to the head of the 2016 economy. And 2 years ago, after I made this prediction, I feel more strongly about it than ever. Or for that matter, what I wrote 2.5 years ago, that Obamacare was the singularly most destructive piece of legislation Congress has ever passed. Other than, of course, the creation of the Federal Reserve in a sparsely attended holiday session on December 23rd, 2013. Or, I should say, 1913. Number 3. Well, I certainly got this one wrong, even if I more than made up for it a year later, when my direst prediction of all article of January 2nd, 2015 embraced an updated long-term thesis of inexorable commodity destruction, which was that gasoline prices would resume their historic march to record levels. Actually, this prediction wasn't as bad as it sounds, as unlike crude oil prices, which have since plunged 70%, gasoline prices have been artificially held up by taxes in many high-cost parts of the world, such as San Francisco, for example, where I took a picture of a gas station selling low-grade gas for $3.60 per gallon just 5 weeks ago, or Spain, where on a Spanish-based radio show I did last week, the host told me gasoline prices in the southern portion of the country had barely budged. That said, now that the world has been overcome by an historic glut of crude oil, gasoline, and natural gas, it's difficult to envision a scenario outside of hyperinflation or an extremely atypical OPEC decision of anything but falling prices for the foreseeable future. Number 4. The one I nailed most completely, which in a world where my biggest picture fear is currency collapse, makes it perhaps the most important of all, which was that, quote, multiple currencies will experience dramatic declines relative to the dollar. To that end, as long-term readers know, I don't believe it possible for the dollar to materially plunge against other currencies, as given its, for now, reserve currency status, any global economic panic will cause capital flight into it. That is what occurred in 2008, and what is occurring now. To wit, since this prediction in December 2013, the dollar index has surged from 80 to 98, which sadly dramatically understates the carnage in non-first world currencies, which on average have plunged far more dramatically, particularly in the dozens of nations dependent on commodities for the majority of government, municipal, and corporate tax revenues, which I might add is where the vast majority of the world's fiat currency using population reside. As we speak, the average currency is at or near its all-time low, and whether or not politics or other factors cause the dollar to rise or fall against the principal components of the dollar index in 2016, which I'll get to momentarily, the odds of the dozens of weak links in the global fiat Ponzi chain getting significantly stronger against the dollar, particularly given the hideous outlook for commodity prices, appear slim to none. Number 5 is yet another one I nailed, i.e., global social unrest would expand. Frankly, that might be the understatement of a lifetime, given historic levels of unrest in all 4 corners of the globe, from the Middle East to South America and Europe, with much more to come, as the terrifying ramifications of collapsing global economic activity and care of central bank monetary inflation currencies come home to roost. When I wrote crashing oil prices portend unspeakable horrors 14 months ago, I wasn't just whistling Dixie, as frankly, it wouldn't surprise me if World War III broke out in the Middle East in 2016, ironically in Syria, one of the few nations with no significant oil reserves. Much less in Europe, where disenfranchised Arabs from collapsing oil-dependent nations are fleeing to, creating massive social and geopolitical tensions. In many ways, 2016 could prove to be the most pivotal socio-economic point in modern history, with this year's historic elections in Spain, Italy, Portugal, and Greece, and France potentially being supplanted by the overthrow of the Brazilian government, the Brexit of Great Britain from the European Union, and the failure of a majority government to be formed in Spain, just before Catalonia, Spain's wealthiest province, votes to secede. And oh yeah, America itself, amidst an expanding poverty crisis and the destruction of its middle class, which looks poised to embrace the dark side in the form of the extremely dangerous demagogue, Donald Trump. And that's just the, in Donald Rumsfeld's words, known unknowns. As for my number 6 prediction for 2014, again, 2014, not 2015, I predicted the gap between paper and physical gold and silver prices will expand. This one is difficult to gauge, as despite record physical demand for both metals, first in 2014 and next in 2015, not to mention collapsing above-ground inventories, on and off backwardation of the futures markets, and both peak gold and silver in 2015, evidence of physical shortages has been sporadic at best. In the gold market, we've yet to see shortages develop in the retail segment, although admittedly retail markets in many other markets have tightened up due to tariffs, taxes, and other regulations. However, the silver market has unquestionably tightened significantly amidst record physical demand in the U.S. and Royal Canadian Mints, for example, in both 2014 and 2015. In fact, this summer, from the time of the Sunday night paper massacre in mid-July until roughly mid-September, U.S. physical silver supply dried up, yielding dramatic premium increases and delivery delays. Though not as dramatic as in 2008, it was certainly a clear signal that silver is just one major crisis from a severe, debilitating physical shortage. As for 2014 prediction number 7, that the glaring weakness in true U.S. unemployment will become widely understood, I'm quite sure I nailed that one too. Since then, whilst the official U.S. unemployment rate has plunged from 6.7% to 5.0%, ironically the same rate as in April 2008, just before the economy crashed, the labor participation rate has collapsed from 63% to a new 38-year low of 62.5%. Whilst the mix of new jobs, that is the ones not created by the birth-death model, has been dominated by part-time, minimum wage, benefitless jobs in the retail and healthcare sectors, nearly exclusively in the 55-plus age category, as millions of elderly, savingsless citizens take menial jobs because the American dream of one's golden years of retirement has been destroyed by economic ruin and monetary inflation. For 2014 prediction number 8, I anticipated that interest in alternative currencies will expand worldwide. And by alternative currencies, I was of course referring to Bitcoin as much as gold and silver. And please note, I never predicted alternative currencies would definitely rise in 2014, only that interest would increase as fiat currencies were debauched. Regarding the former, I certainly couldn't have foreseen the bankruptcy of the world's largest Bitcoin exchange, Mt. Gox, in February 2014, which not only caused Bitcoin prices to crash 90% in short order, but scarred the fledgling currency's reputation for months thereafter. That said, it has recently had a resurgence, rising as high as $500 per coin last month, and it remains to be seen how it will react to further fiat currency collapses and government capital controls in 2016 and beyond. As for gold and silver, again, the conflict of exploding, record physical demand and historic, unrelenting paper suppression has been one of the biggest financial market stories of 2014 and 2015, and unquestionably will be so again in 2016, as economic Mother Nature inches, and perhaps surges, toward her inevitable victory over what I deem the New York gold pool. Last but not least, my final 2014 prediction was decidedly wrong, that the gold-silver ratio would decline. As during 2014, despite record global silver demand, the ratio rose from 62 to 74, i.e. the upper end of the trading range of roughly 50 to 80 of the past 20 years. That said, it spent 2015 trading in an extremely tight range, despite the horrific commodity collapse that arguably should have caused the gold-silver ratio to surge further, as it did in the early stage of the 2008 cartel-orchestrated commodity crash. As I write, it looks like 2015 will end with the gold-silver ratio at exactly where it started, around 74, lending evidence that it may well be stabilizing, particularly in light of the aforementioned severe physical shortage we experienced late this summer. Well, that was my late 2013 predictions for 2014, which, cumulatively speaking, were quite prescient. Not even close to 100%, in many cases still incomplete. However, the big picture items played out quite close to my expectations, whilst the market-based one, particularly as relates to precious metals, were influenced more by expanding levels of official and unofficial intervention than anything else. That said, as you're about to see, my late 2014 predictions for 2015 were, for all intents and purposes, a Grand Slam home run, starting with my first prognostication of retail Armageddon. Well, that one's a no-brainer slam dunk, as not only did 2014 turn out to be the worst holiday spending season since 2009, but full year 2015 retail spending has been disastrous, from 1% retailers like Nordstrom's to middle-class chains like Macy's and the home of the 99% Walmart, which this fall predicted next year's sales would be no better than this year's. Throw in the hideous statistic of Black Friday sales falling a whopping 10% from a year ago, and massive across-the-board discounting, such as Microsoft's 17-day 50% off sale on Xboxes, and unquestionably retail Armageddon has arrived. And just wait until 2016, when the record amount of inventories, employees, and commercial real estate properties have to be liquidated. Secondly, I predicted last December that we'd see the return of the pigs. Again, this story is far from complete. However, indisputably, the Greek situation has morphed into complete political, economic, and social chaos, featuring the Greek people first voting in the anti-Euro Syriza party in January, then voting oxy to July's nationwide referendum regarding the potential third Troika bailout, only to be ignored by the government, which technically defaulted on the nation's debt, setting up what will inevitably be a nation-destroying calamity in the coming years. As for Portugal, just last month, a nearly unheard of in the first world political coup occurred when anti-Euro parties overthrew the newly elected pro-status quo prime minister. In Spain, not only did secessionist parties take over Catalonia, its largest province, but vowed to secede by the end of 2016. Whilst in Italy, Beppe Grillo's five-star movement, which also wants to leave the Eurozone, has become the largest party in Italy's parliament. And don't forget France, which, although not technically a pig, has the same political, economic, and social issues, let alone after last month's hideous social stability shocking terrorist attack. Just 3 weeks ago, Marine Le Pen's anti-Euro National Front Party won decisive, unprecedented parliamentary elections in France, setting the stage for Le Pen to be elected president in 2017. Whilst in Spain, just 1 week later, the anti-Euro Podemos party won an equally decisive victory, breaking up Spain's two-party dominance of the past 3 decades. Third, I predicted the first signs of yen hyperinflation, which incredibly has not yet occurred, despite the Bank of Japan's not only mandating Shinzo Abe for several more years of currency destruction as the nation's prime minister, but essentially extending Abenomics from its initial 2-year term, which would have ended in April 2015, to infinity, including the addition of a stock monetization scheme to its already historic bond monetization, which to date has resulted in the Bank of Japan owning an incredible 52% of the entire Nikkei equity ETF market. To that end, the fact that the yen-dollar exchange rate has barely changed in the past year should tell you all you need to know about the health of the US dollar. And as for the future, who knows how things will unfold in the demographic hell and nuclear waste the land of the setting sun, that is Japan. However, I continue to maintain it will be the first world Western nation to experience 21st century hyperinflation. Fourth, I predicted oil collapse contagion. First, per my October 2014 article, Crashing Oil Prices Portend Unspeakable Horrors, and second, in my 2015 predictions in December 2014, when I stated that, quote, 2015 shale oil equals 2008 subprime mortgages, referring to the incredible $500 billion of junk bonds and leveraged loans used to finance the U.S. shale bubble alone. As it turned out, contagion was the understatement of the year, as an expanding energy complex collapse has caused the implosion of economies, currencies, political regimes, and social stability. And sadly, it's just getting started. Fifth, I anticipated mining industry paralysis, given collapse in gold, silver, and base metal prices. In other words, dramatic capital expenditure cuts, layoffs, debt restructurings, mergers, and ultimately production-crippling mine shutdowns. Well, this process certainly accelerated in 2015, even if at a slightly less dramatic pace than I had anticipated. That said, we are clearly on the cusp of the next leg down, as evidenced by last month's announcement by Anglo American, the world's 5th largest metals miner, that it is selling 60% of its assets, suspending its dividend, taking up to $4.7 billion of write-offs, and laying off an astounding 85,000 employees, or 65% of its global workforce. Throw in the expanding implosion of Glencore, the world's largest commodities trader, as well as its twin sisters Trafigura in Europe and Noble Group in Asia, and we have the makings of a true mining industry catastrophe in 2016. And now that 2015 is ending, with prices much lower than a year ago, particularly base metals such as copper and zinc down 27% and 30% respectively, and the aforementioned global mining industry paralysis I predicted a year ago has shifted from inevitable to imminent, which will obviously be good news for silver bullion holders, as not only is silver production on a pace to fall between 5 and 10% in 2015, but given that 55% of global silver production is the byproduct of copper, lead, and zinc mines, it's entirely possible that last year's Miles Franklin All-Star Silver Panel webinar prediction of ultimate declines approaching 25 to 50% is looking more and more feasible. And as for primary gold and silver miners, here's what I wrote last year of what I anticipate will happen if prices continue to be suppressed so maniacally. If, in fact, the cartel is dumb enough to cause gold to end the year below 1,200, let alone silver near $15 an ounce, it will only serve to maximize mining write-offs, heightening expectations of what the Miles Franklin blog has predicted all along, of collapsing global production, potentially on a permanent basis. Sixth, I simply forecast falling commodity prices. In fact, there's no need to add further commentary to what I wrote a year ago. Other than that, the CRB commodity index plunged 25% in 2015, slicing through its 40-year low of 185, it's around 175 right now, like a hot knife through butter. Ironically, starting its final violent 13% plunge the very day the Fed commenced its rate hike in December or bust campaign in late October. On that note, here's what I wrote a year ago, verbatim. Quote, outside outright hyperinflation, it is difficult to envision rising prices of any industrial commodities amidst an expanding global recession, much less one characterized by the largest debt loads in global history and accelerating currency wars. Supply and demand for nearly all commodities is way out of balance, not just due to weak economic activity, but the massive overcapacity caused by years of the misallocation and abuse of zero-cost central bank funding. Seventh, an equally tape measure home run in my prediction of, quote, collapsing currencies, which frankly has, if anything, been more dramatic than even I anticipated, per what I wrote exactly 12 months ago. Quote, as I predicted last year, that is, in December 2013, the dollar will not only rise against fringe currencies, but even reserve currencies like the euro, yen, and pound. Not because of U.S. economic strength, but as in 2008, because during times of crisis, global capital always gravitates to the most liquid assets. Throw in the additional issue of literally dozens of nations depending heavily on commodity exports to fund their governments, and it's not difficult to envision ruble crises breaking out the world round. Of course, no one will be injured more by a dollar surge than corporate America, which will lobby to the death for the Fed to step up QE to enable the reporting of higher profits for the 1% that benefit from its policies. Well, the Fed hasn't yet stepped up QE, which unquestionably will arrive when the U.S. government's manipulation operatives lose control entirely. And to the contrary, it managed to sneak in an 11th hour rate hike, which comically has yet to actually occur in the money markets, amidst its desperate life-or-death game of credibility chicken. Irrespective, the dollar is up sharply against nearly all global currencies, on average to or near its all-time high against a variety of first, second, and third world currencies, from the aforementioned commodity currencies to so-called reserve currencies like the euro and pound. Ironically, the only currency that hasn't depreciated against the dollar this year, essentially ending the year where it started, is the Japanese yen. However, given that the hyperinflating yen lost 50% of its value from mid-2012, when rumors of the pending launch of Abenomics commenced, through mid-2014, its ongoing Bank of Japan catalyzed collapse was perhaps due for a temporary pause. Eighth, I predicted the aforementioned explosion of global, socially motivated political instability, which, as noted above, has decidedly occurred, with the most decisively divisive events such as the exploding Arab migrancy crisis, the expanding war on terror, the recent historic elections in France, Spain, Portugal, and the UK, the hyperinflationary devaluations in Argentina, Venezuela, and Azerbaijan, and the imminent impeachment of Brazilian President Dilma Rousseff, all occurring at the end of 2015, portending ominously for what 2016 will bring. And last but not least, I amorphously forecast the reemergence of real money, which, while difficult to quantitatively measure, definitively progressed in 2015 if record global physical gold and silver demand amidst collapsing above-ground inventories was any measure. Heck, at current prices, well below the cost of production, the cartel's most vicious, relentless year of price suppression yet only amounted to 8 to 9% dollar price gold and silver price declines, whilst in most other currencies, utilized by the vast majority of the world's population, prices continued to rise. Given that dollar-priced gold and silver are amongst the power that be's last to go, canary in the gold mine markets, this prediction will obviously face the most artificially created resistance. That said, for the billions of people holding currencies in which gold and silver have risen over the past 2 years, I'd say the aforementioned reemergence of real money has decidedly commenced. On that note, it's now late Sunday afternoon, and I'm exhausted from not only commentating on my last 2 years' predictions, but reliving them in just a few hours' time. Once I wake up tomorrow morning, I'll pen my 2016 predictions, which, given the complexity, volatility, and instability the world is currently facing, will take a bit more thought. And afterward, as they say, the rest will be history. Okay, it's now Monday morning, as the second lowest volume week of the year commences. The overnight news of Japan's worst combination of economic data since the Fukushima tsunami, featuring a whopping 2.5% plunge in November retail sales and surging unemployment, was met by plunging Chinese stocks. And of course, paper silver for the 574th time in the past 653 trading days, at exactly the 2:15 a.m. open of the London pre-market paper trading session. Japanese stocks, of course, were higher, whilst U.S. and European stocks were flat, and the dollar and 10-year Treasury yield were essentially unchanged. Makes a lot of sense, huh? Throw in the head of ISIS calling for a global jihad, and the publication of extremely alarming financial data from the rate-hiking Fed that in the last quarter alone, U.S. bank demands for commercial and industrial loan collateral had their largest ever spike to an all-time high level, and you can see why investors were so fearful of silver, but indifferent to stocks, bonds, and the dollar, right? And by the way, if one headline tells a story of where the entire world's political and economic situation is headed, it's this weekend's headline from Ontario, Canada, i.e. the global center of mining finance, where the province's leader, Kathleen Wynne, is asking patriots to donate their tax refund or write a personal check to defray the province's massive $300 billion debt load. Putting that gargantuan amount into perspective, Ontario's population is just 35% of that of California, America's most debt-infested, overregulated, overtaxed state. However, Ontario's $300 billion of debt is a whopping 70% of California's $430 billion. And yet, Mademoiselle Wynne is asking Ontarians to give more, despite Ontario already being the most heavily taxed municipality in North America. Oh well, just more of the same as we end this year of paper precious metal infamy, en route to the ultimate endgame of cartel collapse, which may well be as imminent as it is inevitable. That said, I've had some time to ponder my views over the next 12 months, which frankly appears more unclear than any near-term period I can remember. To wit, last year's predictions, which largely came true, seemed like no-brainers at the time, such as collapsing commodities, currencies, and political and social stability. This time around, whilst the latter two items are more certain than ever, I'm finding it more difficult to conceptualize the most likely scenario for asset prices, given what I anticipate to be the most difficult economic and tumultuous financial market conditions since 2008. In other words, there's no telling how much control might be lost, and subsequently, how far central banks will take their market manipulation and currency debauchery attempts. With that all said, here's my best guess of what 2016 will hold, which again is the most difficult forecasting period I have ever attempted to predict. Number 1. No meaningful improvement in commodity prices, with the potential for an historic crash. In other words, barring a worst-case scenario of an all-out loss of central bank control, yielding crashing financial markets and a subsequent outbreak of hyperinflationary-inducing monetary lunacy, my thesis of relentless and potentially expanding commodity oversupply is stronger than ever. Exactly a year ago, in the direst prediction of all, I cited David Stockman's Great Deformation thesis for my belief that commodity prices had entered what may well be their worst bear market in generations. And since that time, not only have commodity prices crashed, with the CRB Commodity Index plunging through 40-year lows, but oversupply conditions have dramatically worsened in the vast majority of commodities. Except, of course, the non-commodities that gold and silver are, which is why their supply-demand outlooks are the polar opposite of essentially the entire commodity complex. Sure, the powers that be will do everything in their power, including said hyperinflationary monetary policy, to reverse the damage. However, with global economic activity starting the year at its worst level in decades, with its highest level of debt ever, and oversupply conditions unlike any witnessed in modern times, it's difficult to conceive of any normal situation in which commodity prices meaningfully rise. Which leads to my second prediction, that central banks will take the final currency war thermonuclear. In other words, if you think 2015 was a big year for hyperinflationary monetary policy, get ready for the big one in 2016. To wit, an astonishing 27 central banks reduced interest rates and or initiated or expanded quantitative easing programs in 2015, in nations where a cumulative 57% of the world's population resides. And that doesn't include a whole bunch of nations whose currencies are pegged to those currencies. And that compares to the 20 central banks that raised interest rates, but only 8% of the world's population resides in those countries. which in and of itself is misleading, as 3 of the 20, South Africa, Brazil, and the United States, account for nearly the entire 8%. In the former two cases, to support currencies that had collapsed to all-time lows, and as we speak remain there, as such too little too late efforts decidedly failed. And regarding the latter, i.e. the Fed's quarter-point rate hike that is yet to actually be seen in money markets, much less in the Fed's balance sheet, as it continues to reinvest Treasury in interest payments and the proceeds of maturing Treasury bonds, it's laughable to consider this a so-called tightening of monetary policy. Given the aforementioned collapse of global trade, parabolically surging, unprecedented worldwide debt loads, and the resulting historic financial stress, as we are currently witnessing in the high-yield and credit default swap markets, it's equally difficult to envision a scenario in which, cumulatively, central banks aren't more aggressive in 2016 than 2015, starting with the European, Japanese, and Chinese central banks amidst historic political, economic, and/or social instability. For prediction number 3, I anticipate a dramatic expansion of volatility in the currency markets, as the aforementioned final currency war goes thermonuclear, led by, I might add, the continued death by 1,000 cuts devaluation of the Chinese yuan, which ironically started its recent relentless, nearly daily downward leg, essentially the day it was accepted into the IMF's pathetic, useless, strategic currency basket. In other words, when the PBOC devalued the yuan by roughly 6% in August, which I might add I predicted 24 hours in advance, it was a mere warning shot, with the big guns being held out until the IMF's currency basket decision 3 months later, which for all intents and purposes served China in no manner other than a publicity event. To that end, given how far the euro and yen have fallen in recent years, much less as the collapsing U.S. economy will shortly put the Fed into the untenable position of pondering looser monetary policy immediately after its desperate face-saving rate hike attempt, it's extremely difficult to forecast where the largely immaterial dollar index will be 12 months from now. Frankly, there's no telling how these so-called Big Three central banks will respond, given the various political and economic pressures weighing on them, let alone amidst a U.S. election year, where the democratically appointed Fed chairman will unquestionably do whatever it takes to help Hillary Clinton. That said, given my earlier forecast of continued commodity price weakness and thus global economic deterioration, it's equally difficult to envision a scenario where the dollar materially declines against the peripheral currencies of nations where more than half the world's population resides. To that end, I 15 months ago penned the single most bullish precious metal factor imaginable, referring to the very same economy-destroying currency volatility described above. Undoubtedly, what we witnessed on this front in 2015 was a major factor behind the record physical demand the world is seeing, and if I'm correct about 2016's potentially devastating currency volatility, it's difficult to envision a scenario where physical demand doesn't rise further. Which leads me to prediction number 4, i.e. that quantitatively, global economic activity will weaken significantly in 2016, from levels I have currently characterized as the worst of our lifetimes. To that end, as we speak, nearly all empirical measurements of global trade are pegged to multi-year and in many cases multi-decade lows, such as the Baltic Trade Index and the Chinese Containerized Freight Index, whilst inventories such as crude oil and natural gas are at all-time highs, and telling metrics like the U.S. inventory to sales ratio are flashing recessionary signals. Amidst an environment of surging debt levels, collapsing retail sales, and expanding government regulations, like Obamacare for example, it's difficult to envision any other scenario than weakening global economic activity, including, I might add, a better than 50% chance that, despite the most advanced data cooking tools of all time, the Bureau of Labor Statistics is forced to admit not only negative GDP growth, but a rising unemployment rate. Fifth is a prediction that directly dovetails with numbers 1 through 4, and thus is the same prediction I successfully made in both 2014 and 15, which is dramatically expanded worldwide political, geopolitical, and social instability. That said, I truly believe 2016 will be uglier than the past 2 years, as economic trends are measurably weaker, debt levels significantly higher, oversupply dramatically more daunting, and reactionary political movements far more advanced. Such as, for instance, the aforementioned political chaos in, to name a few, Portugal, Greece, Spain, France, Brazil, and Turkey, the Catalonian secessionist movement, the potential Brexit vote, and heck, the upcoming Swiss referendum of whether fractional banking should be abolished. Or the exploding European migrancy crisis, which threatens to tear the political and social fabric of nations as large as Germany and France apart. And of course, the wild card of the so-called war on terror, currently focused on the newly formed, universally perceived worldwide threat named ISIS, of which thus far the US, Russia, Syria, Iran, Iraq, Turkey, France, and the UK have already committed troops. Sixth is one of the most difficult of all my predictions, which is the direction of interest rates. In a world where collapsing currencies are pushing rates of second and third world rates up, whilst ZERP and QE programs and expectations are simultaneously pressuring rates in supposedly first world regions like Europe, Japan, and the US. To that end, it's difficult to envision such trends changing anytime soon, given my expectation of extreme currency volatility and economic weakness. Yes, hyperinflation is the end game that must eventually arrive. However, the path to and timeline of such a world-changing event are nearly impossible to predict. So I'm going to simply assume a most likely scenario of continued monetary easing, debt monetization, and rate suppression in first world nations, with a far less sanguine outlook for so-called emerging markets, which are far closer to said endgame and far more likely to advance toward it in short order, particularly in so-called BRICS nations like Brazil, South Africa, and Russia, which are so hopelessly dependent on strong commodity prices. As for the United States, the proverbial $64,000 question is when the Fed will be forced by deteriorating economic data and potentially financial markets to reverse course, admit the recovery is dying or dead, and consequently return to aggressive, overt easing mode. What odds do I attribute to such a scenario over the next 12 months? Let's say 60 to 70%. Seventh is a prediction everyone should pay close attention to, as it could directly affect your personal finances, which is increasing worldwide draconian government attempts to steal your money in some way, shape, or form. Such movements have been gaining momentum for years, and hopefully you haven't forgotten the type of things that were discussed at the height of the last financial crisis in 2008, such as, for instance, the confiscation of IRAs, capital controls, and the prevention of cash withdrawals from banks. Since then, we have seen several isolated active asset grabs, such as 2013's Cyprus bail-ins. However, passive movements like enactment of the U.S. FBAR and FATCA laws the official enactment of bail-in protocols in nearly all Western nations, including the U.S., are where the real danger resides, as all it takes is one major crisis for such passivity to morph to action. Just look at the aforementioned Ontario request to volunteer personal funds to pay down the province's skyrocketing debts, if you want a blaring red warning. Or heck, the equally skyrocketing costs of Obamacare, which undoubtedly will become the subject of future tax increase debates. Or India's until now request for citizens to lend the government their gold in return for hyperinflating rupees at the embarrassingly low interest rate of 2%, which has thus far failed. Or Brazil's inability to fund its own Olympic Games, which will unquestionably lead to creative government funding efforts. Or Europe's dire attempt to fund future Greek bailouts when no such funds exist. Or Spain's to fund a potentially Catalonia-less nation. Or who knows how many nations' efforts to fund Middle Eastern war when it inevitably escalates, etc., etc., etc. Or, in other words, a rallying cry to protect oneself, such as, in Jim Sinclair's words, getting out of the system as best as possible, financially arming oneself with precious metals stored in a place you consider safe, we'd suggest our Brinks Montreal storage program, and generally speaking, starting to consider when and how your government might start to do what governments have done throughout history, particularly those utilizing collapsing fiat currencies as monetary assets. Last but not least is the question most of you want to know most, which is, what will gold and silver prices do over the next 12 months? The most difficult question of all, given how the ultimate canaries in the coal mine are by far the most manipulated markets on the planet, as they have been for the past 15 years, but particularly since they nearly destroyed history's largest, broadest, most destructive fiat Ponzi scheme 4 years ago. And frankly, the manipulation motto I mumbled circa 2005, i.e. each day worse than the last, has never been more relevant, as easily 2015 witnessed the most relentless, blatant price suppression efforts yet. Which shouldn't surprise anyone given the exponential increase in worldwide money printing, debt, and systemic instability, which could easily go parabolic if gold and silver price suppression fails to do its job. That said, the dramatic escalation of such ominous political, economic, and monetary issues, combined with the aforementioned gold and silver price suppression, has yielded record-high physical precious metals demand, for all intents and purposes, record-low physical inventories, and last but not least, peak gold and silver this year with the prospect of further, potentially dramatic declines for years to come. To that end, you ask, will 2016 be the year when the covert New York gold pool disintegrates, as the overt London gold pool did in 1968? And if so, will it be due to a usual suspect, like a physical COMEX default, a black swan event, like bombs over the Middle East, a Greek default, or a draconian decree from Donald Trump? Or putting it simply, the inevitable swamping of razor-thin supplies by surging global demand? I have no idea, and won't purport to even give odds that this will occur in 2016. However, I will certainly say that said odds are higher than at any time since I entered the sector in 2002, and given the aforementioned perfect storm of surging demand, vanishing inventories, plunging supply, collapsing currencies, exploding central bank money printing, expanding social unrest, and burgeoning worldwide military confrontation, it's difficult to envision a situation in which the 4-year bear market in dollar price gold and silver doesn't end, particularly as nearly all precious metal mines and base metal mines that produce precious metals as product are hemorrhaging money and thus likely to start shutting down en masse, particularly after year-end reserve resource and operations reviews are completed. And again, I'm only referring to the so-called bear market in dollar price gold and silver. As for the billions of people that utilize collapsing currencies the world around, precious metal prices decidedly bottomed in the past 12 to 24 months. On that note, I think I'm about tapped out on this financial labor of love, which has taken me close to 5 hours to script. Hopefully that's enough to digest over the New Year's weekend. I wish I had something more positive to say, but my reputation has been developed over the past 13 years by speaking the truth. To that end, my message of wealth protection with gold and silver, which I have personally heeded since 2002, has never been more urgent. And thus, I'll conclude by wishing you and yours a fantastic holiday and a happy and prosperous new year. And when the calendar turns next week, if you do decide to protect your assets with precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.